Markets ended higher. Oil prices fell back on hopes of tensions easing in Iran, despite mixed signals. For more on what he's watching in the market, let's go to Jeff Weniger, head of equity strategy at WisdomTree Asset Management. Thanks for joining us today.
Thanks, Marilla. My pleasure.
Oil has been fluctuating with everything coming out of the Middle East. Where do you see the biggest impact of any oil price rise?
In terms of sectors or the market, I guess you could say, let's talk the market, I suppose. And we have a big rotation on our hands compared to 2025. That's one of the areas. I mean, if you're thinking about the groups that have been performing really well year to date, you can almost argue the risk on concept with industrials. Maybe that's a topic for another day, but certainly energy. Earlier, before the war with Iran, you had basic materials doing really well. And of course, this is all happening in concert with some very, very risk-off concepts. The software Mageddon, I guess you could say, is a key one. But look, the way to be treating this market is reflation on. If you consider sentiment where we were maybe 60 days ago or so, you couldn't find an oil bull to save your life. And you almost start to wonder whether or not you could have energy as a sector, energy as a concept. Some of these value-oriented economies start to get some love here in 26, 27, 28, and so forth, not because of a temporary crude oil spike, which is probably what it is, but just because we had so many portfolios that were so lopsided towards tech and comm services.
Okay, let's talk about the other big story that has been moving through the markets, private credit. Under pressure. Yeah. You have a chart, I know, showing the fall in some stocks like Blackstone, KKR, Carlyle. But how much of the pain could spill into the equity markets? What's your gauge?
Yeah, and taking a look at this is one of those concepts that's been really a head scratcher, I guess you could say, for me. If you look back the last 5, 10, and maybe 15 years or so, but really in the last 10 years or so, remember what we're doing here. When we're taking a look at the price action of a KKR or a Carlyle or something like that, it's equities versus equities. We just have different names for them, right? There's private equity and then there's public equity. But when it all boils down to the business model, it's stocks and equity capital. And to the extent that you have this basket of the major private equity houses, which are private credit houses as well, getting absolutely lopped. And I mean, the key word here is lopped over the last, depending on which ones you're picking, you can almost date it back to July, but most of them since September. You know, you're now at 6 months of this lopping, this absolute carnage in the stock prices for these names, and the S&P 500 is only off mid-single digits. Amid that, I would say of all the charts that I put out on social and the various concepts that are keeping me awake at night, this is the one. You have these private equity houses that are really up against the wall in terms of their stock price. I don't know necessarily if the business model is. And meanwhile, it might not feel that way, but really we haven't had much of a sell-off in the broad market.
So in that case, do you think that it's a limited effect or the effect will be limited?
No, probably not. I mean, sometimes you have to get a feel for what the tape is telling you. And you have, in this case, financial concerns that are having a very rough go of it. In sharp contrast to the energy plays, which are seemingly on. We had in terms of just the S&P 500 financial sector, which is not really encompassing of the private equity houses, this was a sector that was doing fine up until a few weeks ago, and now it's one of the worst performers. And so you don't want to see that as a value person. I mean, I'm at WisdomTree. We have a lot of value mandates. We don't want to see financials doing poorly, but we can't wish and hope and pray for the stock market. Most of the value concepts are on. Industrials tends to populate value mandates, staples as well. Staples is a quality factor type screen as well, and we think we're going to be on with quality in 2026. But you know, it's not good news in the financial sector, and I think we might have a little bit more room to the downside. I mean, I just don't know that the general public fully appreciates just yet how difficult it is to make redemptions in private credit. It's starting to splash the headlines with each passing day, and I think that that's one of those things that could be an overhang. It's, you know, if the Iranian war is the number one issue for many viewers, I'd say it's my number two. The number one issue is, You got these private credit funds. Morgan Stanley was putting out, well, one of the recent reports, Morgan Stanley said from 2015 to 2025, the private credit as an asset class had a standard deviation, annualized standard deviation of 2.2. I mean, come on.
Okay.
I think that's a little bit ridiculous. And so we have to maybe re-rate and reappreciate that there is, though a lot of the paper is probably money good and just fine and dandy, we don't need to lose sleep over it. I mean, I just think that a lot of people have been lulled into this volatility sleep here, and I think maybe we just need to re-rate it.
Okay, let's get to a couple of other sectors you like at this time. Where would you go right now with energy doing what it's doing? Gold has been off. It's got a little bit of comeback today, but where would you put money?
Well, energy is one of those that's not screening so much on the quality factor, and we're game for the quality factor in 26, mostly in a reversion of the mean concept. We were putting out some of the concepts of late. If you remember, we had from the April 8th lows into about mid-December-ish, one of the boldest pieces of outperformance by the market relative to the S&P 500 quality. So the S&P 500 quality was just having an absolute horrible last 8 months of the year because everybody was bidding up all the garbage in the market. And if you take a look at the extent of that underperformance, you could say, by quality, it was second only in that window of time to a period back in 99. So we had to go back a quarter century to an uh-oh year, which is that is an uh-oh year, to find that degree of underperformance. We started to carve it back, I guess, in recent weeks with a little bit of risk-off paradigm, but there's still a lot of room there. And so you start saying, okay, well, quality is on for 2026. Which sectors screen that way? Interestingly enough, industrials, which is a little bit difficult if you have an issue with risk on, but industrials is one of those groups. Staples is one of those groups. So those two probably look like they're okay for the rest of the year for some outperformance. And then I'd say just in terms of just multi-year ownership, lack of ownership. I mean, we had a 2 handle on the S&P 500 energy sector as a proportion of the total market when things were low. I mean, remember, this was like 60 days ago. People were talking about $40 crude oil, and nobody wanted to touch the Chevrons and Exxons of the world. Yeah. And so just remember that we're only a couple months into that rotation. So I think that's a sector that can be on as well.
Okay. Jeff Weniger, got to leave it there, sir. Appreciate your time on the program. Thank you.